Hello everyone. Welcome to the GCV Energy Council Innovation Showcase. I'm Tony San, your host today. I'm the director of CVC at the GCV International, a petrochemical company out of Southeast Asia, but also have a global footprint. I currently serve as the chair of the GCV Energy Council. While we are waiting for some more people to sign in, let me take just like maybe 1 or 2 minutes to give you a quick overview about Energy Council and what we'll be doing in the next kind of like an hour and a half. For those who are not familiar with us, GCV Energy Council is the platform for energy CVCs to connect, to explore innovation and investment opportunities, and also to provide thought leaderships to the common challenges the industry faces. The backbone of the council is the Council Advisory Board, which currently have 12 members. And when you see an energy related events or article published by GCV, hosted by GCV, there's a very good chance that someone from the council is consulted. Events like today's is a really good example, which is the result of the collaborative efforts between the team of GCV and also industry leaders from the council. If you're interested in learning more about us, please visit the GCV website, click energy, and then you can find more relevant information to your right. I'm seeing we're still having people coming in. For the event today, Fernando from GCV will first share their analysis of the energy investment data, like the trends. And then I will moderate a panel with 3 council members to discuss the dynamics of the energy investment in the current market. And after that, we have 7 fantastic startups funded by energy CVCs. They will come to the stage to share how they plan to address the different needs in the energy transition. Now, without further ado, let's welcome Fernando to share his insight.
Thank you, Tony. Hi, everyone. I'm Fernando Moncada, a senior reporter at GCV. And I'm just chiming in here for a quick, brief few minutes. I don't want to hold up the panel too long, but just to show a few quick slides on investment in the energy sector to hopefully set the stage a little bit for the following discussion. And here just to preview the upcoming panel after that'll come on in a few minutes. Some real star power here, so we'll definitely be gleaning some good insights. But before that, I just want to share a few data slides here. So the first one, it's a very simple graph here showing the levels of investment in terms of dollar invested, as well as deal flow in corporate backgrounds and in energy startups over the past several years. And we see a kind of similar pattern as we see in a lot of sectors here where it really shoots up around 2020, 21, 22. But notably, it does not seem to go down much really between 22 and 23 amid the venture downturn. So while other sectors were panicking and frankly some were cratering a little bit, investment in energy was very resilient, right? So we see investment volume goes down by a relatively small amount, right, of 3 billion between 22 and 23, and granted, 3 billion was the kind of the total amount invested in 2019, but relative to 2022, it's not that much of a drop. And the deal flow did not go down at all. And if you look at a number of other sectors there, that bar in 2023 will have been far lower than it is on the energy one. And back in February, my colleague Rob Levine wrote a piece kind of exploring why has this been so resilient? And there are a number of reasons, but among them, I think the broad push for cleaner energy and clean tech is a huge factor here, right? Even as fossil fuel production was still up, new energy generation and its accompanying infrastructure have really thrived. And solar energy, for example, in particular, has been doing great in recent years, driven by lower costs, both in terms of the panels themselves, as well as the unit energy produced. And then, things like energy storage has also been a vibrant space. Hydrogen continues to move along and has strong potential for baseload generation. And of course, the specter of nuclear fusion is becoming increasingly real. So in this next graph, we have energy investments by subsector between 2016 and 24. I should note that this is expressed in percentage terms of deal count. So the number of funding rounds, we're not talking about dollars invested here. But we see, there are 2 kind of constant powerhouses in renewable energy. and energy storage management and equipment. And what we see over time is that renewable energy has gained ground as oil and gas has lost a lot of ground there. Energy software has remained relatively level in percentage terms. That's the dark blue section at the top there. And energy storage has kind of oscillated, but remained roughly in the same range. This next one is the clean tech investments by oil and gas corporates. So whereas the previous two slides were CVCs generally, this one's looking just at the oil and gas. I think it's quite an interesting comparison to see where the energy companies are putting their money. And over the past year or so, we see that it fluctuates, but technologies like carbon capture, nuclear, and hydrogen have been higher on the investment priority lists of energy companies relative to other technologies. It seems they're consistently raising multiple rounds virtually every quarter, at least as far back as 2022. And we also see, of course, a smattering of other technologies, monitoring energy technologies, thermal, solar energy, waste to energy, but the deal flow there is more kind of inconsistent. This one, we're kind of zooming out a bit to see whereas the previous slide was just about where the O&G companies were investing in clean tech, this one looks at their broader kind of investment targets really. And what's notable here is that we see a very sharp drop in the dollars invested right after 2021. And if we remember back to that first slide I showed, where the corporate backed deals did not go down, really, it just kept going up to 2022 and stayed level through 2023. This really highlights, how other corporates have really rushed in to kind of fill a void there in the energy space, and how resilient energy has been, attracting investments from all over the place, even if its kind of own corporates have been a bit more cautious perhaps than they used to be. And then just a final slide here for me before I hand it back to Tony. We're just looking at a few individual kind of energy majors and where they've been investing. And I think it's quite interesting. We're seeing, and this is over the past decade, by the way, and clean tech, that's the one in the dark green there, has been very strong pretty much across the board. No real surprise there. A few companies in the second or third place, we see IT that's received a huge amount of investment. This is obviously driven by the need for digitization over the years. Transport and mobility has also been attracting more money, and we see particularly from companies like BP and Shell, who've really doubled down on things like their EV charging network rollouts. And of course, they're just in the light blue. We see that the kind of core oil and gas operations investment for them has kind of kept plugging along pretty much consistently. So that's really it from me, really. And hopefully that provides something of a skeleton for our panelists to build on. And I'll turn it back over to you, Tony.
Yeah, thank you very much, Fernando. Yeah, so now let's get into the discussion piece. So we have 3 council members joining me to share their view of the market. So for all the participants, as you may have already seen from chat box, so if you have a question, please type it in the Q&A box. So for the panel discussion piece, our plan is to have about 25 minutes of discussion and then save maybe 5 minutes for the actual Q&A. And okay, so I'm starting seeing that panelists are signing on. So we have Tina, we have Federico. Is Taha here as well? Or okay, here we go. Awesome. All right, so we have all the panelists over here. So why not we start from Taha, from you first? And do you mind just kicking it off by sharing who you are and also a little bit more about Aramco Ventures? And maybe Tina and Federico can go after that.
Thank you, Tony. Appreciate the able to participate on this panel. I lead strategic venturing for Aramco Ventures. Recently joined 6 months into the job here in Saudi Arabia. And so Aramco Ventures recently, as you may have seen in the last few months, we're pretty large, right? Like number 2 in the world for the $7 billion allocation, which is divided across 2 main divisions of funds. One is called the Prosperity 7, and the other one, the Strategic Venturing. Prosperity 7 is looking for very disruptive technologies, agnostic to any vertical, so they can invest in fintech, health tech, agriculture, AI, computer, cybersecurity. And then strategic venturing, as from its name, we look for technologies which kind of fits with our base business. So we will invest in industrial technologies. We will invest in technologies in refining and chemicals, and also a big focus on energy transition. So we're evaluating carbon capture, sequestration, hydrogen, e-fuels, batteries, and that sort of thing. So these are the two big buckets that we invest from. We have teams in US, UK, China, and we're recently B7 opened an office in India as an emerging market. So overall, we are a global team, and we are collaborating with all the leading players in the CVC domain to advance energy transition.
All right, so I think I'll go next. I'm Tina Tosukowong. I'm the investment director at TDK Ventures. We are the early stage ventures investment arms of TDK Corporations. We have 3 funds, roughly overall 350 million AUM. Currently, there are 2 active funds. The flagship fund 2 focus on investing in both the digital transformation and energy transition, and typically seed to Series Bs globally. And then we also have a specialty fund called Fund EX1 that is focusing on energy transition theme in North America and in Europe. We currently have about 30 to 35 team members across several geographies. Headquarters is in San Jose. And we also have regional office on the East Coast in Boston, also have a European office in London, India, and also in Japan. Currently about 38 portfolio companies ranging from digital areas such as robotics, computing, connectivities, industrial and decarbonization areas. Several companies like battery recycling, critical mineral, energy storage company, and we are venturing into e-fuels and probably looking at other hard to abate sector in the coming years as well.
Hi everyone, I'm Federico Cristofani and I lead VX Ventures, which is the CVC of Vista Energy. And Vista is an independent Latin American energy company leading the shale oil development in Vaca Muerta, Argentina. Just a comment on Vista, it's a very young company, only 6 years of age, born through a SPAC in 2018 with an incredible year-on-year growth. And we created VX in 2021 as a way to play the part of the company's strategy in the energy transition arena. We invest in basically a very broad range of industries which fall in the category of energy transition and climate tech. We invest in early stage startups from seed to Series A mainly, and with a focus on Latin American founders and startups, but not exclusive. So far we've made 15 investments in startups and we approved 2 more, so we're quite active.
Sounds good. Yeah, thank you all for joining me. So, all right, so I'm going to ask a few questions to all the panelists so that I'm hoping that you can all chime in and share your view. So my first question is really, we just saw what Fernando just shared, right? That's more on the macro side. So based on your own observations, what is your view of 2024? Again, this is probably a tough question. So for the energy investment, would you call 24 as a good year or a bad year? So Tina, you're sitting next to me on the screen. Maybe I'll go.
Yeah. So I think it depends on whose perspective you're looking at, right? I would say that prior to pandemic, up until the SPAC craze, I think the power was in the hands of the founder and entrepreneurs. During those good years, the round was moving fast. Companies got multiple term sheets and things like that. And fast forward to now, I think you've seen a lot slow down in terms of the momentum, and I think the power is sort of like switching into the hands of the investor side. The time it takes to close the round, especially for Series B, Series C companies, taking a lot longer. People are doing careful diligence, and the valuation on very good companies still going very strong in selective sectors. But in the broad outlook for the overall energy sectors, a lot of flat rounds, some down rounds, and things like that. So tough time for companies. So I think if you have portfolio company raising, I would say it's pretty important to be very vigilant, understand their current cash flow, their cash needs, and give it enough time for fundraising and things like that.
Federico, any comments on that?
Yes, I will subscribe everything that Justina said. So it's hard times for founders and easier times for investors. And also I think it's a good time to enter and invest in companies because valuations are reasonable, relatively low, right? I think it's also part of a rationalization of the market, which makes sense because it was an exuberance times in 2021 and 22. So following that, we are positive and investing. Actually, this year to date, we have approved 2 investments and close to approved another one. So I think it's a good time to invest. And when you think in energy, it's a very broad theme. So there may be buckets that are more cold and more hot than others. Specifically, I think, for example, green hydrogen was a bit of a hype past years, and today you can see we think like the whole VC ecosystem becoming more rational and looking more into the cost competitiveness of solutions, right? And that affects every kind of industry, business, and also the energy space.
And Taha, any comments?
Yeah, building on what Tina and Federico mentioned, I'll bring a little bit of a perspective from an oil and gas company. I think 2024 is definitely a year where we are seeing energy transition companies, offering different solutions are kind of materializing, right? Even though you see there were targets for 2050, 2030 about net zero, but historically, if you look at how the oil and gas have transitioned, from horses to trains to cars to mobility, it's not a 10-year or 15-year journey, right? It takes a long time, and the dependency on oil, and as the population is growing of the world and people are moving more towards the cosmopolitan cities, the demand is very, very high. So we recognize the value of what we use today, and obviously the vision is to transition that to more environmentally friendly technologies. Will take a longer time, and the biggest challenge for energy transition, at least from where I sit, is the economical cost of bringing these technologies into the commercialization, right? Green hydrogen, ammonia, batteries, or geothermal, or even fusion. So it's if you look at that, and then I think it will take some time and lots of technology and entrepreneurs to push that envelope to get to a point where some of these technologies are affordable, and also as you see the market changing, and we're facing elections in the US, so some of the dry powder is available, but we are not seeing, as Tina mentioned, that the entrepreneurs have to be very careful when they bring forward their funding needs. So that's just my view from where I sit.
Yeah, thanks.
Just I would like to add up to Taha's point, and I agree 100% in the sense that the energy demand globally just only keeps going up, and there's no vision that this will stabilize or decrease in the near future, right? And this includes oil and gas, and that's why, with the corporate vision of Vista and within VX Ventures, we are positive on investing and trying to bring lower carbon oil and gas to the market, right? And also we're investing in there with startups and with technologies and solutions to lower the emissions from oil and gas, which we think is a solution more than a problem to the energy transition on one side. And we're also very positive on nature-based solutions. We think it's a very competitive way of reducing emissions and making a good impact on the planet.
Yeah, sounds good. I think all of us, we are kind of active investors, and we are in the energy space. So I'd be curious to understand, investment is just small part of our job. We also have other side, which is portfolio management, and investment is just one side of the coin. The flip side is the exit, right? I think one of the findings from GCV's slides earlier is they were talking about in the 23s, a lot of investment, but very few exits. So I'm curious to see from you guys, how would you advise your portfolio company? So where are the exits? And do you think things will get better from here, or is it even worse?
Yeah, I could say a little bit to start this, going back to the energy transition, right? So there is difference between investing in a SaaS company or into a hydrogen or a carbon capture. The time horizon for that exit is very, very different, right? You go from 2 to 3 years, and you go in energy transition could be 10 years, 12 years, because these technologies are still very early stage. The cost factor and building a project, government subsidies, all that has to come into place for these technologies to be commercialized, right? So the exits are tough in the energy transition space, but as we are, as a venture community, whether oil and gas and other sectors are working collectively to advance that, right? I mean, who else is going to fund these high risk technologies to come to the market? So the vision, for, at least from Aramco's side, is to really help, these technology advance on on the higher TRLs, and provide a sandbox in our operations to be tested, which can take a long time. So there's a good support mechanism available to advance these.
Yeah, I think, and for us, I think in general, the advice for our CEO, whether it's early stage or late stage, is really like focus on generating real revenue, right? I think the valuation along the way, if you get a big upround, it's a good thing, but eventually your revenue has to scale to justify those valuations. And early time, it's always challenge. All startup have to go through the cycle of figuring out the product market fit. They have to talk to a bunch of the customer and figure out which vertical, which industry has a higher velocity, get engaged. And also as the investor, we also try to bring together a really good syndicate that will help them in the long run, from both financial VC as well as strategic investor who could become the ecosystem partner, providing helps in terms of process capability, raw material, as well as a go-to-market channel. And sometimes it's pretty hard to figure out who's going to be the acquirer at the end. So it is very important to engage multiple parties throughout the life cycle of the startup companies. And especially in the energy sector, the good thing is that if you look on the bright side, there's a lot of funding available, right? The IRA can really catalyze and accelerate the development of the technology and help de-risk. And that really help the dollar invested in the startup go a long way. The LPO, the loan program office, is pretty active. And if you look in Canada, the government support is super strong. In Europe, the legislation framework is really strong, and there's also a lot of government funding. So on the bright side, the macro doesn't look good, but at the same time, a lot of technology, a lot of company that was just born during 2020, 2021, during that big rush to the clean tech 2.0. Right now, a lot of them is at the point where they have to build the first plant and get through the valley of death, and there are those public fundings available to help them weather through the storm. So
I will just some comments over Taha's and Tina's, and agreed on what they explained. So it's a complex market for our VC in terms of exits. And as Taha was saying, in terms of energy transition, the development of these technologies takes a lot of time. So we need to be patient. And I think part of the value that we bring as CVCs, we are patient. We know so we're comfortable with the risk and and being patient for this kind of startups and technologies to be developed. In our case, it's not an issue right now because it's a young fund, started investing a couple of years ago, so we're not thinking right now in having to have exits. But I think it's relevant always to have in mind what are the potential exits. And I think maybe the VC ecosystem as a whole is changed in a sense that the typical VC play may not be continued as it used to be, right? And also these energy startups are different. They're not a marketplace. They're not SaaS. Things will take longer. CapEx will be required. So I think also the IRI, LPO are key instruments for startups to exploit, right? But again, startups and founders need to think of a possible M&A, exit. And I think M&A is more possible, probable than IPOs in general in this space.
Okay, thanks. I think what I'm trying to get is, I think there are a lot of points we're talking about. Energy transition is very different animal, right? It's a different cycle, different players in the space. And on the other hand, we are all CVCs. I think in our industry, we have this saying, each CVC is a different animal. So I'd be curious to understand how each of you react to this kind of environment side differently. So maybe I'll get started from Taha, because like you said, mentioned, Aramco Venture is one of the biggest energy CVCs out there. So you're looking at so many things in parallel. So how do you actually prioritize, specific sectors based on year, based on technologies? So what is your overall allocation strategy?
Oh, thanks for that. Yeah, having a big checkbook comes with a big responsibility, right? We are in that space, and we want to make sure that we have enough distribution in our funds to invest in early stage. So we actually, under those two allocations that I talked about, we also have a seed capital available where we write our smaller checks and take higher risks to advance those. We also invest in fund of funds where we get a lot more deal flow and able to look at a broader spectrum. And then on the, we recently have, looking at the market and energy transition technologies, we are going more towards the barbell approach, where we, kind of focus on the promising technologies and build over time. So let's say if we have done a seed investment, 2 years back or last year, and if that technology is advancing, at a good pace, then we will keep building and put more and more money into it. So we also have a allocation under our funds to call late stage venturing, where in one company we can go up to $100 to $200 million to really take it to the commercial stage and prove it out. So as Tina was mentioning, right, we are not only an investor, but we also a customer of that company to adopt that technology and sort of take it to the commercial scale. But obviously in the VC space, as Federico mentioned, its collaboration is very important with all types of different. Every CVC brings a different expertise and different flavor to the table, and if we collaborate enough on this particular vertical of carbon capture or hydrogen, I think we can advance much faster and reduce the risk, and also able to give opportunities to the the bigger the company, we move slower, but smaller companies can move much faster. So it's all a combination of winning winning the opportunity.
Thanks. Now, Tina, to you. I think TDK Venture is one of the most active CVCs in recent years. So how does your thesis evolve over time, and what is your process to decide, all right, we're going to do, let's say, fusion this year, next? So I'm curious to understand how you do that so quick.
Yeah, I think in terms of how it evolved over time, I would say that the main investment area still stay the same, right? Digital transformation and energy transition, and looking at areas that TDK can potentially learn and also contribute to startups. And before we do the investment, we start with the deep explorations. So we want to pick the area where we think that the market size is big and growing, and understand the real unmet need from the customer point of view. So maybe give specific example. We just finished the data center cooling deep exploration, because we've seen the velocity of the energy used from data center was so high, and 40% of that energy is actually going to cooling. So it's an oxymoron, but the data center cooling is hot. So that's what we found. And then we had to do the deep exploration, talking to the operator, the technology provider, to actually understand and analyzing if there's a good exit in the particular space before we decide to do the investment. So that has been the same practice for the past 3 years for the fund. But we also evolve over time in terms of the geography focus. At the beginning, we just have only the US team, but throughout the pandemic, you've seen the deglobalization happening. So had we gone back to 2019, we would have thought that at the time, like if we are opening a new office, it's probably going to be in China. However, when deglobalization is happening, we ended up seeing the opportunity for investing in India. So we now have an office in India and then Europe. So I think those are some of the changes that we have seen as a strategy. But overall, the investment practice still stay the same for us. Yeah.
Okay, thanks. And how about you, Federico? I think Vista is one of the newer energy CVCs just coming to the game. So what's your unique approach coming to this market?
Well, I think in our case, in LATAM, we're kind of filling an empty space because you don't see much or none other VC funds willing to invest and take the risk of deep tech and energy tech companies. Neither VC funds, and there are basically none other CVC funds, right? At least looking actively in the region for early stage startups, right? So we see on one hand there's an opportunity for us to fill that space, and we see ourselves as part of a bridge when we look at a startup that is interesting and want to invest. So we invest early stage, either a seed, pre-Series A or Series A, and I think we can be a bridge for this startup if they develop correctly the technology and the commercial business and business model to go to the US or to global markets, right? And I think this webinar itself is an example of that, because I proposed Einstein, which is one of the companies presenting. So this kind of bridge, I think that we can add value in bridging startups from LATAM to the world. And sometimes we can do also the bridge the other way around, in the sense that, so we invest mainly in LATAM, but we look also global startups where there's a very strong strategic fit with the core business. And we have made a couple of investments where we invest in a startup, maybe in the US, and we can leverage our footprint here in LATAM to help the startup grow in a new business, a new market, right?
Okay, thanks. Before we get to the Q&A, I have one final question for all the panelists. If you can just summarize in short is, so why does a startup choose to work with CVCs? So, because we are all energy CVC, I think we kind of implied a few answers over here through the panel, but what are the unique values that your fund is actually bringing to your portfolio?
Yeah, CVCs, they bring not only the capital, or I can say patient capital. We are, we're looking at the commercialization of technology, but we also bring the sandbox and the expertise from engineers working in the field. So for example, if you're building a robot that's going to do some type of inspection or some type of functionality in the oil and gas, the people who actually have years and years of experience can help the startup. We make that available to the company, right? Talk to our experts and see how you can change or modify your design for the real conditions. And then, of course, when you're ready, we can provide the sandbox. You can bring and test your technologies. So it's kind of a approach that very different from private equity. I mean, private equity obviously plays their role as well, right? Going into companies early enough and then kind of driving the financials and making the company ready for the exits. That's also very important, because we're in the venture business, right? So we want not only the company to be successful, but financial returns as well. So CVCs play the very critical role where they provide patient capital, sandbox, and the expertise to help tech companies to be successful.
Yeah, I think my view is also similar to Taha. I think CVC brings value beyond just the capital. You can provide the early validation of the technologies. Oftentimes, the process capabilities that we have, providing the right electronic components to the startup companies that really help shorten the time to market for them. And they can also oftentimes be the go-to-market partners as well. And we have a really good GCV network, right? So oftentimes the startup finding that if they come work with us, we can also make introductions to other CVC that we have worked with in the past. And this is really a people business. So it's always a good thing to have different people in the syndicate that can bring different types of values and have diversity of thoughts.
Yeah, I agree totally with what Tina just commented. So it's not only help de-risking the technology with our operations as a potential client and offering the startup the view of what the client wants in terms of solution, which is key. Also, the technical people that can help them develop the solution. But again, also not only the other CVCs that could invest, but also commercial contacts, right? That can be other additional clients to grow the business. So I think, yeah, we can bring a lot of value. And I think also the CVC model is perfectioning or improving year on year in terms of establishing market terms and knowing that a mixed cap table of CVCs, VC funds, and others, it's a good combination for the startup.
Thanks. I'm seeing a lot of questions are actually being popped out in the Q&A box. I think here's one. I think I'll probably read one of those questions and would appreciate all three of you, the panelists, can answer this. So this is a question from Sam Patel. So will your business as usual business be disrupted mostly from the inside or outside? I think as energy CVC, we kind of can see the things from both sides. I think it'd be curious to understand your perspectives. So anyone want to take the first bite? So you see the disruption from inside or outside for your business as usual?
I think it has to be from outside, right? Whether it's the entrepreneur developing new technologies, I felt like that has to be driven by the change in externality that they've seen, that the trend is changing, and therefore you have to have a new solution to solve the customer's problem. And the question is, can that solution come from inside or come from outside? And the best combination would be really understanding the problem. And if we see the early stage startup looking at a good solution, then as a CVC, if we can really be the one to get them to speak between the corporate and the startup, perhaps the combined force can really bring the solution to market faster, and it will be the equal win opportunity for both the LPs of ours and the portfolio of ours.
Yeah, I agree. I mean, the whole reason to set up CVC is because we are externally facing, and it's much easier and faster to disrupt from outside compared to the research and development inside the company that can take much longer, right? And as Tina mentioned, it could be a sometimes collaborative effort where our research dollars can also help the outside disruption to advance much faster. But generally, trend, if you look at all the cases from the very beginning, all CVCs were externally facing, and they wanted to bring technologies from outside to their mothership, and some of them actually were set up outside of their mothership to be more open to external market because you can do development much faster.
Yeah, I agree as well, and I think part of the goal of the CVCs is to be the eyes of the parent company in terms of new developments, right? So they're from the outside, and part of the goal is, okay, so we are the eyes for the company in looking for disruptions and new technologies. And the thing is, what do we do with that, right? So we prepared for the disruptions for our businesses.
Okay. For the interest of time, I'll just read one more kind of half questions, which I think is kind of an interesting aspect. So the question is, what are the challenges for energy-related startups to operate outside its headquarter countries? So I think I'm curious too, because Tina, you mentioned like you guys have multiple offices. So I'm curious if you can address this. So this is more like advice for startup.
Yeah, I think it's really a challenge. Really, because I have a very good example. We invested in German e-fuel companies, right? And you need the products to be deployed everywhere around the world. There's a demand everywhere, but being a startup going by themselves to other continents is super hard. So I would tie it back to the question earlier. This is a reason why you want the investors who can help the startup to go to market. And we've seen in the case of our e-fuel startup companies that the co-investor, corporate wind venture really helped champion them to find the project, understanding the site, the location, feedstocks, as well as potential go-to-market partner with them. So those are one of the example how you could leverage your strategic investor to really help you accelerate the speed to market, because suddenly you're not one little company anymore. You have friends in that particular geography who can actually give you the exponential, opening exponential amount of doors to get you set up and start getting into that market.
Great, awesome. For the interest of time, Tina, Taha, and Federico, thank you so much for joining me. I'm hoping that I'm trusting that a lot of the participants also have some takeaways bringing home before they kick off the weekend. Again, thank you very much.